Today at the National Press Club, the Governor of the Reserve Bank, Philip Lowe. As the COVID-19 pandemic causes havoc around the world, in Australia, a nascent economic recovery is underway, but with uncertain times ahead. Looking ahead to 2021, Reserve Bank Governor Philip Lowe.
Good afternoon, ladies and gentlemen, and welcome to the National Press Club of Australia and the Westpac Address. My name is Laura Tingle. I'm the club president and the 7:30 correspondent for politics. Our guest today is Philip Lowe, the Governor of the Reserve Bank, one of the key players setting economic policy in these difficult times. Dr. Lowe has been a speaker at the club in the past, but only from Sydney. Despite the potential disruption risks of COVID, Dr. Lowe agreed to come south to the national capital a couple of months ago to speak to us in person today. If you are following the conversation online, you can find us on Twitter. Our user handle is @PressClubAust and our hashtag is NPC. Everyone, please welcome Dr. Lowe.
Good afternoon, everyone, and Laura, thank you for that introduction, and thank you for the invitation to join you at the National Press Club. This is the third time I've had the privilege of addressing the National Press Club, but as you say, the first time in Canberra. So it's great to be in Canberra for the first time here, but it's particularly great to be able to travel to Canberra. I haven't been able to do that for a while, so I enjoyed coming here today. The world has changed tremendously since my previous address to the Press Club in February last year. We've had a pandemic, the biggest contraction in output in generations, the closure of our borders, very substantial fiscal stimulus, near zero interest rates, and quantitative easing by the central bank. All that in just a year, and none of it was predicted. It was therefore with some nervousness and trepidation that I titled my remarks today, "The Year Ahead." I did so though because at the start of the new year I thought it was important that I set out our thinking about the Australian economy and our thinking about monetary policy over the next year or so. But before I do that, I want to offer three observations on the year that has just passed. The first is that Australians respond well in a crisis, and I think collectively we should be proud of that. The second is that the economic downturn was not as deep as we initially feared, and the bounce back has been earlier and stronger than we were expecting. And the third is that as we start 2021, there's still quite a long way to go before we reach our goals for full employment and inflation consistent with the target. I'd like to elaborate on each of these observations because they're quite relevant to thinking about the future. First, our national response. As a community, we've pulled together in the common good, and we have been prepared to do what's necessary to contain the virus. Our public administration and health systems have worked well in the public interest. Governments responded quickly to the pandemic, and decisive fiscal and monetary responses have helped many people in the community. Our banks have worked well with their customers to help them meet their obligations. And because of these collective efforts, Australia is in a much better place than most other countries. And that's true for both the economy and the health situation. I think most of us feel we're much better off being in Australia than any other place in the world. The second observation is that despite the pandemic having very significant economic costs, the downturn was not as deep as we thought it was going to be, and the recovery has started earlier, and it's been stronger than we were expecting. Employment growth has been strong recently, as have retail sales and house building, and across many indicators, including GDP, the outcomes have been better than our central forecasts, and many of the outcomes have been better than our upside scenarios as well. So there's a lot of positive news there. Because I'm from the Reserve Bank, I have some pictures, and I'm going to show you an illustration of how things have turned out better than was expected. In August last year, our central forecast was that the unemployment rate would end 2020 at close to 10% and still be above 7% at the end of next year. As you can see in the upside scenario, the unemployment rate was expected to end last year a little lower than 10%. But even in the upside scenario, it was still expected to be around 7% later this year. Thankfully, the actual outcomes for unemployment have been much better than this. The peak in the unemployment rate now looks to be behind us. It was 7.5%, and we ended last year with an unemployment rate of 6.6%. It's reasonable to ask what explains these better than expected economic outcomes. I want to point to three factors. The first is the success that Australia's had in containing the virus. That success has meant that the activity restrictions have been less disruptive than we feared. It's allowed more of us to get back to work sooner, and it's reduced some of the economic scarring from the pandemic. As is increasingly clear from our experience in Australia and the experience elsewhere around the world, the health of the population and the health of the economy are inextricably linked. The second factor explaining these better than expected outcomes is the very significant fiscal policy support in Australia. Which you can see in this next chart, if we measure the change in the budget position, it's almost equivalent to 15% of GDP. That's a very strong fiscal support. It's bigger than what we've seen in many other countries. Most of this support has been delivered by the Australian government, but the states and territories have also played an important role. This support has been more substantial than we assumed in August when we put our forecast together at that time. This support has provided a welcome boost to incomes and jobs, and it's helped front-load the recovery by creating incentives for people to bring forward their spending. There's also been a positive interaction here with the health outcomes, which have allowed the policy support to gain more traction than would have been the case if the health outcomes hadn't been as positive as they were. The third factor is that Australians adapted and innovated. When the virus first came to our shores, many people understandably hunkered down. But as the days wore on, we adjusted and we changed what we did and how we did it. This resilience has helped keep the economy going and has kept many people in jobs. Many firms changed their business models, they moved online, they used new technologies, they reconfigured their supply lines. Households have adjusted too, with spending patterns changing very significantly. Some of the spending that we would normally have done on international travel, on entertainment has been redirected to other areas, including electrical goods, homewares, and for some people, home renovations. Online spending has also surged, and as you can see in this next chart, online spending was up 70% over the past year. These changes in our spending patterns have been challenging for many businesses, but the ability and the willingness of Australians to keep spending has helped the overall economy, and it's kept people in jobs. My third observation about the year just past is that despite these positive economic outcomes, we still have quite a way to go. There is still very substantial spare capacity in the Australian economy. The unemployment rate today is higher than it has been for almost 2 decades, and there are many people in our community who can't get the hours of work that they want. And in terms of output, we remain well behind where we thought we would be when I spoke to the Press Club in February last year. As you can see in this next chart, when the national accounts are published for the December quarter, they are likely to show that the level of GDP is 4% lower than where we thought it would be a year ago. 4%, it's a big number, there's a big gap there. On the nominal side of the economy, there's also a fair way to go. In underlying terms, inflation is running at 1.25%. It's obviously well below the 2 to 3% medium-term target we have. And wages growth, as you can see in this chart, is the lowest that it's been in decades. It's running at just 1.4%. Given the spare capacity that currently exists in the economy, we're expecting that these low rates of inflation and wage increases are likely to be with us for some time, in fact for some years. So this brings me now to the year ahead. In my view, we can draw some comfort from the year that's just passed. Our ability to pull together and the earlier expected bounce back are both positive developments, and they provide a basis for confidence about the future. Yet even so, the path ahead is likely to be bumpy, and it's likely to be uneven, and it will be some time before we're back to full employment and have inflation back to the target. As was the case last year, much depends upon the path of the pandemic. The development of vaccines in record time is clearly good news, and it's reduced one of the big uncertainties and it could provide the foundation for a vigorous and robust sustainable recovery in the global economy. But this outcome is not assured. The global rollout of the vaccines faces very significant challenges, and there is still a range of other uncertainties around the global economy, including the ongoing trade tensions. I'm sure we all hope for the best here, but we also need to be prepared for further setbacks in what remains a highly uncertain world. The RBA will be releasing a full set of updated of economic forecasts on Friday when we release the Statement on Monetary Policy, but today I can give you the key numbers. In preparing these forecasts, we've assumed a rollout of the vaccines in line with current government guidance, and we've also assumed that international travel remains highly restricted for Australians for the rest of this year. Our central scenario is that the upswing in the Australian economy continues with above-trend growth over the next couple of years, as you can see in this chart. GDP is expected to increase by 3.5% both this year and next. And given the recovery that we've had so far, we're now expecting the level of GDP to return to its end 2019 level by the middle of this year. And that's 6 to 12 months earlier than we were expecting not so long ago. Notwithstanding this recovery, we are not expecting the level of GDP to return to its previous trend over the forecast period. And that's largely because of lower population growth. When we prepared the forecast a year ago, we were expecting population growth to average 1.6% last year and this year. As you can see in this chart, the actual outcome is going to be much lower than that. And in 2021, we're now expecting the population to grow by just 0.2 of 1%. That would be the smallest increase since World War I, when Australian soldiers left to fight in Europe. This slower population growth has a direct effect on the size of our economy, and it means that we will not get back to the previous trend for GDP anytime soon. In per capita terms, the story is more positive. We expect to get back, but not fully back, or we expect to get mostly back, but not fully back to where we were expected to be before. But in terms of the overall size of the economy, it will be smaller because population growth is smaller. In the labour market, we're expecting the rate of unemployment to continue to decline. In the central scenario, the unemployment rate is expected to reach 6% by the end of this year and around 5.25% by mid-23. Job vacancies, job ads and hiring intentions at the moment are all at quite high levels, and that suggests continuing solid employment growth over the months ahead. Beyond that, some slowing in employment growth is expected when the JobKeeper program comes to an end in March, but we expect the unemployment rate to trend down over the course of this year. Given this outlook, including the high unemployment rate, we're expecting wages growth and inflation to remain subdued. In the central scenario, wages growth is forecast to pick up from its current low rate, but to do so only very gradually and still be below 2% at the end of next year, still be very, very low. Consistent with this and the ongoing spare capacity in the economy, inflation in underlying terms is also forecast to stay below 2% over the next couple of years. The central forecast for 21 is for inflation to be 1.25%, and for 2022 inflation is expected to be just 1.5%. In headline terms, though, inflation is expected to spike to around 3% in the June quarter, and this largely reflects the swings in the prices of childcare and some other administered prices. But after the spike, we expect to see headline inflation to return to below 2%. So that is a broad outline of the central scenario. On Friday, we will also be publishing downside and upside scenarios as we did through the course of last year. The downside scenario is one in which there's a combination of further sporadic domestic outbreaks, a delay in the rollout of vaccines, and a worsening global outlook. The upside involves further good news on the health front and a strong pickup in consumer and business spending, which propels a strong self-sustaining recovery. This is especially so in the light of the very large amount of fiscal and monetary stimulus that's currently in place. In the downside scenario, further progress in reducing unemployment is delayed and it's very limited, and there is also very little pickup in wages growth or inflation from current levels. In the upside scenario, though, the unemployment rate falls faster and it's expected to be a bit below 5% in the second half of next year. So that would be quite a good outcome if we can achieve it. I want to highlight two specific issues that we've been working through as we've put the forecast together. The first is how households respond over coming months to the tapering of the fiscal and other support measures. Unusually for an economic downturn, growth in household income has been quite strong over the past year, as you can see in this chart. This largely reflects the support provided by fiscal policy. Much of this extra income has been saved, with the household saving rate surging to 22% in the June quarter. This extra saving largely reflects the limited spending opportunities during the lockdown, but it's also a response to the uncertainty that people felt about the future. When people are uncertain, they tend to save more and spend less. These extra savings have strengthened household balance sheets, and they mean that many people now have bigger financial buffers than they had previously. So the question here is, what comes next? As you can see in this chart, over the next 6 months, aggregate household income is expected to decline as the pandemic support payments unwind. And normally, when income falls, so does consumption. But we're not in normal times. The extra savings over the past 6 months and the bigger financial buffers that people have can support future spending. People will also have more freedom to spend as restrictions are eased. I think they'll be more willing to spend as uncertainty eases. So we are expecting the recovery in consumer spending to continue. But there are risks to the forecast in both directions here. On the downside, further bad news on the health front or the jobs front could see people restrain their spending again. We could see additional restrictions and increased uncertainty as people want to save more. But on the upside, positive news on the health and jobs fronts could see people seek to catch up on their spending, and they could seek to run down the extra savings, the extra buffers that they've built up over the past year. If that were to be the case, we would see a stronger pickup in the economy than our central scenario. So this is an area we're watching very carefully. One other important factor bearing on household spending is the housing market. When I spoke in Sydney at the National Press Club last year, I discussed how falling housing prices in 2019 was one of the main factors explaining the sluggish economy during 2019. It was all about housing prices declining, and that was hurting the economy. The dynamics of the housing market are now different, and prices across most of the country are now increasing. You can see this in my next chart. It remains to be seen how long these increases will continue, but sustainable increases in asset prices do support household balance sheets, and they encourage spending through positive wealth effects. Higher housing prices can also encourage additional residential construction and support the economy that way. But as housing prices rise again, we will be monitoring lending standards very closely. We would be concerned if there were to be a deterioration in these lending standards, but there are few signs of this at the moment. The second specific issue I wanted to highlight is the outlook for investment. Prior to the pandemic, there were already concerns about the protracted period of low investment, particularly in the non-mining business sector. If you look at this graph, I think you can see why we had been concerned. Not surprisingly, when the pandemic hit, business investment declined further. Faced with a more uncertain environment and with a drop in demand, many firms deferred their investment plans and they sought to de-risk their balance sheets, so they slowed their capital spending. And on a more positive note, as you can see in this chart, there's been a welcome offsetting pickup in public investment, which is, as it should do, playing a strong counter-cyclical role at the moment. We are yet to see the same signs of a recovery in private investment that we've seen in household spending. We're still waiting for this. Investment is, though, expected to pick up as uncertainty recedes and demand increases. This increase in private business investment is not only needed to support the economic recovery, but it's also needed to build the productive capital stock that we need for our future. So this too is an issue that we're watching very carefully. I would now like to turn to the outlook for monetary policy. At our meeting yesterday, the Reserve Bank Board reviewed the monetary policy measures announced last year and also reviewed the outlook for the year ahead. And I'd like to share 6 conclusions of that review with you. The first conclusion is that last year's monetary policy package is working broadly as expected, and it's supporting the economy and helping support jobs. Together, the bond purchases, the term funding facility, the 3-year yield target, the record low cash rate have kept funding costs low for all borrowers, and they've helped ensure that the banking system is able to provide the credit that is needed for the recovery. These measures have also resulted in a lower value of the Australian dollar than would have otherwise been the case. Combined, the various measures have resulted in the RBA's balance sheet increasing from around 180 billion to currently 330 billion, and we're expecting further substantial increases to take place over the months ahead. The second conclusion from our review is that the very significant monetary support we have at the moment will need to be maintained for some time to come. It's going to be some years before our goals for inflation and unemployment are achieved, so it's premature to be considering withdrawal of monetary stimulus. The third conclusion is that we will continue to purchase bonds issued by the Australian Government and by the states and territories at the completion of the current bond purchase program in mid-April. In reaching this conclusion, the board considered 3 factors. The first was the effectiveness of the bond purchases to date. The second was the actions of other central banks. And the third and most important consideration was the outlook for inflation and jobs. With 3 months' experience now on the bond purchase program, it's clear that these bond purchases have helped to lower interest rates, and they have meant the Australian dollar is lower than it otherwise would have been. So it's worked. Australian government bond markets also continue to function well, and the available evidence is that further purchases would not be a source of market dysfunction. In terms of other central banks, most other central banks have recently announced extensions of their bond purchase program, with some of these programs running until at least the end of this year. Given this, if we were to cease bond purchase in April, it's likely that there would be unwelcome upward pressure on the exchange rate. So that was a factor in our decision making as well. And in terms of the most important consideration, the outlooks for inflation and jobs, as I've mentioned a few times already, we remain well short of our goals, and we're likely to be short of our goals for some years to come. Given these considerations and the fact that the cash rate is at its effective lower bound, the board decided to purchase another $100 billion of government bonds at the completion of the current program. These additional purchases will be at the rate of $5 billion a week, which is unchanged from the current program, and other parameters of the current program will remain unchanged as well. These bond purchases will ensure a continuation of the RBA's monetary support for the Australian economy in its recovery phase. The fourth conclusion from our review on Tuesday is that the term funding facility will be maintained as it is. Banks are able to draw on this facility up until the end of June, which means they will have the benefit of low-cost funding out to the middle of 2024. The board would consider extending this facility if there were a marked deterioration in funding and credit conditions in the Australian financial system. At the moment, though, there are no signs of this. Our markets and our financial system are working well. The fifth conclusion is that the 3-year yield target for Australian government bonds will be maintained. This target has helped anchor the Australian yield curve, and it's reinforced our forward guidance regarding the cash rate. Later in the year, the board will need to consider whether to shift the focus of the yield target from the April 24 bond to the November 24 bond. In considering this issue, the board will be giving close attention to the flow of economic data and the outlooks for inflation and jobs. It's made no decision on this issue yet. The final conclusion is that the cash rate will be maintained at 10 basis points for as long as is necessary. As I've said previously, the board has no appetite to go into negative territory, and it's done as much as it reasonably can do with interest rates. Before increasing the cash rate, the board wants to see inflation sustainably within the 2 to 3% target range. It's not enough for it to be forecast to be in that range. We want to actually see it sustainably within that range. Meeting this condition for an increase in the cash rate will require a tighter labour market and stronger wages growth than we're currently forecasting. It's difficult to determine exactly when this condition might be met, but based on the outlook I've shared with you today, we do not expect it to be before 2024, and it's possible that it will be later than this. So the message is interest rates are going to be low for quite a while yet. The Reserve Bank is committed to provide the support the economy needs as it recovers from the pandemic. We want to see the unemployment rate come down, we want to get back to full employment, and we want to get the inflation target achieved. So we will keep doing what we're doing until we achieve those goals. On that note, I wish you all the best for the year ahead. Let's hope it's a bit more predictable. Thank you for listening, and I look forward to answering your questions.